Welcome to Market Newsroom. Today, we are examining why the Strait of Hormuz is keeping oil markets on edge. Oil prices dropped sharply after reports of progress in talks involving Iran, Oman, and the United States. Traders hoped an agreement would restore shipping through the Strait of Hormuz, and West Texas Intermediate crude fell more than 10% at one point this week. But the move did not mean the crisis was over. Fresh Houthi attacks hit Saudi Arabia, shipping terms remained unsettled, and only 6 crude tankers cleared the route outbound during the week. The sell-off happened because oil prices include a geopolitical risk premium, an extra amount buyers pay when conflict might interrupt supply. Progress toward reopening Hormuz made traders believe more oil could reach world markets, so part of that premium disappeared quickly. Yet a political agreement and safe shipping are not the same thing. Iran has discussed tolls and restrictions on vessels from hostile countries, while regional attacks continue. That gap between diplomatic promises and physical security created the whipsaw. The first reaction was a steep decline in crude as traders priced in more available supply. Energy stocks then swung between a lower oil outlook and renewed fears of disruption. At the same time, gold rose above $4,300 an ounce as investors sought safety. Bitcoin and Ethereum also firmed amid the uncertainty. Together, these moves show a divided market. Oil traders lean toward diplomatic progress, while buyers of safety assets still treated regional risk as unresolved. The largest risk is that an announced deal fails to produce reliable passage. More attacks could discourage tankers, while tolls or restrictions could keep costs high even when the route is technically open. Expensive insurance and limited traffic would continue to support an oil risk premium. A secure reopening would help energy consumers and could ease inflation pressure. Failure would affect more than producers, refiners, shipping companies, import-dependent economies, and businesses exposed to fuel costs could all feel the impact. Investors should first watch whether negotiations produce a final agreement with clear rules for inbound and outbound shipping. Next, follow actual tanker traffic rather than political statements alone. Rising vessel counts would provide stronger evidence that supply is returning. Also monitor new Houthi attacks, Iranian tolls or vessel restrictions and shipping costs. Finally, watch energy shares, United States diesel exports, and gold for signs of how markets are pricing the risk. Until physical flows normalize, volatility is likely to remain high. That is today's Market Deep Dive. Subscribe to Market Newsroom for more clear, investor-focused analysis.